All right, welcome back to the 7 Simple Steps to Smarter Investing Fast Track, exclusively here on Synvestable. This is step 5 out of 7 in the 7 Simple Steps. I hope you're enjoying the process so far. Last week we learned the third big principle as to what creates world-class investors, making better entries and exits, and how we can do that on Synvestable. This week, I'm going to show you some really cool stuff. Some stuff that even professional money managers don't even do that you can do on Synvestable. You're going to learn how to fine-tune, deep dive, and really squeeze all the juice out of your portfolios that you create on our platform. So grab a coffee, pull up a chair, sit in front of your computer, get this stuff under your fingers so that you can make it a habit for a lifetime. And without further ado, let's get to the video. Okay, welcome back. So last week we went over how we can make better entries and exits using Synvestable. Now we've gone through all of the big 3 principles as to what creates world-class investors. Finding great investment opportunities. We know how to do that now. Allocating capital strategically. We know how to do that using our portfolio tools. And make better entries and exits using SynSense predictions, analyst recommendations, and our target monitoring system to passively monitor when events happen within our watch list portfolios. Today, I'm going to show you a tool that's exclusive to our Quant Premium subscribers, and it's a tool that really allows you to fine-tune and squeeze more performance out of your portfolios. So if you're a Quant Premium subscriber, you can follow along with me. Even if you're not a Quant Premium subscriber, this is something that you'll want to see and learn how to use for when you're ready for it. So if I click on this portfolio, I'm going to click on this want but can have portfolio. This is a portfolio of companies that I created that I want to be invested into, but right now their valuation just isn't favorable. I don't like their price right now. So I just kind of threw them all into a watch list so I can keep track of them. But if you're a Quant Premium subscriber, what you're going to do is you're going to click on this Performance tab, and this is going to run a quantitative backtest of this portfolio relative to the S&P 500. So if I go to this, I can see that this portfolio has underperformed the S&P 500 from the beginning of the year by about 4% down. And if I scroll down, I can see all of my quantitative ratios here. And if you don't know what they are, you can hover over them and it'll give you a description. But I'm going to go through them right now. I can backtest from any period I want. So I can backtest a full year prior and then over different market regimes if I want. I can see all of my asset correlations. So I can see how each one of these stocks, how correlated they are to each other. So the higher the number, the more correlated they are. The lower the number, they're anti-correlated, so they move in different directions. And then I can see individual performance breakdowns across all my quantitative factors and then dollar factor returns, which I'll explain. So right now, my portfolio is underperforming the market. Okay, so let's go across these quantitative ratios first. So quantitative ratios like Sharpe ratio, Sortino, Calmer ratio, these are risk-adjusted returns. So what is risk-adjusted returns? It's how much performance you're getting out of a portfolio relative to the risk that you took on. So the performance you're getting divided by the volatility that you have to experience to get those returns. You know that saying, more risk, more reward? Well, not necessarily. For the most part, yes, those are correlated. If you want more returns, you have to be able to deal with a little bit more volatility sometimes. However, if you're really strategic with your stock picking, you can actually have higher risk-adjusted returns, meaning you're getting more performance by taking on less risk. So, as an example, Sharpe ratio is probably one of the most used. I'll kind of explain each one of them. Max drawdown is easy. It's how much of a drawdown from peak to trough that your portfolio is experiencing. Maybe like from this position down to this position. That's max drawdown. Okay. Sharpe ratio is your portfolio's return divided by the standard deviations of the portfolio. So standard deviation, if you remember from statistics, how high or low something goes relative to its mean performance. Okay. Sharpe ratio around 1 is typically what the market is going to return. If you have a Sharpe ratio over 2, that's good. 2.5, that's very good. 3, 4, those are usually if you're really creating custom strategies using Python that quantitative traders would do. It is possible to get a portfolio on Synvestable that have 3 or 4. I created one, but they're less common. But anything over 2 is a good risk-adjusted return portfolio. Most money managers will never create a portfolio that has a Sharpe ratio over 2. Most money managers don't even use this ratio. It's something only quants use. But it's a good way to squeeze more performance out of your portfolio. I'm going to show you how we can change our risk-adjusted returns just by looking at our performance and using the quantitative tools here. So before I go on to anything else, let me explain the rest of these ratios. So Sharpe ratio is your standard one. It's portfolio returns divided by standard deviation. Sortino ratio is a little bit different. It's basically saying that the downside volatility is the only one that's harmful. So it's your portfolio returns divided by only your downside standard deviation. Okay, and then Kalmer ratio is similar as well, but instead of dividing by standard deviation, it divides by your max drawdown. Okay, so just 3 different ways that hedge funds use to measure their portfolio returns and risk-adjusted returns. Most people use Sharpe, but you can get used to using Sortino and Kalmer as well. It's a little bit more telling. So what I'm going to do is I'm going to try to squeeze some more juice out of this portfolio and try to improve its performance in real time. So if I scroll down, I can see all of my positions here. So I can see that SMLR, this one has experienced a 50% drawdown. So that is really dragging down my portfolio. So maybe this isn't a company that I want to invest in because it's just, it's taken a beating and maybe my analysis of it is wrong. The market is really saying that this company is experiencing perhaps some economic problems right now. So what I'm going to do is I'm going to erase SMLR. Okay, and then this backtest will automatically rerun for me. Okay, now let's see. Okay, so that my Sharpe ratio improved a little bit, but my performance really hasn't just yet. So now what I can do is I can just begin to go across these positions and just start to eliminate them in terms of their performance. So MKTX. Okay, maybe this is another one I want to kick out. Okay, backtest will rerun. Okay, so now we're getting better. So look at that. I increased the performance of this portfolio relative to the beginning of the year by about 2%. Okay, and now my Sharpe ratio has gone up as well. So all my metrics are starting to get better as I start to eliminate these highly volatile companies. Okay, so again, let's go to, okay, Adobe has taken a beating, ACN, Apple. Okay, let's do one more. Let's erase Adobe out of here and let's see how we start to perform. Okay, so a little bit more better performance here. Let's do one more. What is this one here? IDXX. Okay, where are you? So we're going to erase this one. Okay, so you can see the process of this is I'm kicking out the ones that in this particular market regime, okay, they are underperforming the market. So maybe I don't want to hold on to those in this market regime. Okay, so as you can see now, my portfolio has now matched the S&P 500. So I just took what was essentially a bum portfolio and now turned it into a performance portfolio that it looks like it's actually outperforming the S&P 500 over some periods. So my performance ratios have gotten better, my max drawdown has gotten better, and now maybe even my asset correlations have gotten better as well. I can go through every one of these and see how correlated they are. So that's just another way that you can really fine-tune your portfolio and squeeze more juice out of them in whatever market regime you want to backtest it over. Okay, I typically will use it in the current year, but if I want to see how a portfolio will perform in other periods, I can do that here. I can also change my allocation. So if I don't like exactly how my allocations are, I can go over here and I can rebalance. Okay, and I can see how that will change the performance as well. So click save and then go back. Okay, now I'm outperforming the index just because I rebalance. That's the magic of these portfolio tools. It's just by tweaking little things here, kicking out positions, adding in companies, rebalancing according to sector or market cap. I'm getting better performance. Look, I have less risk now, less downside risk. My Sharpe ratio is almost gone up to 3 now. That's amazing in terms of risk-adjusted return. So in just a few minutes, I've created a strategy that's outperforming the S&P 500. Most money managers will never outperform the S&P 500 in their career. Using Synvestable in a couple minutes, we just did that. So, well, that'll do it for this week's video for the 7 simple steps to smarter investing fast track. I hope you're enjoying the process so far. You've committed to and becoming a world-class investor. I'll see you next week with more tips and tricks and how to create a better financial future for ourselves and for our loved ones. Until then, cheers and have a great week.